Today we're sat down with, what would we say, Mitch is probably our high-level financial advisor at the moment. Mitch has got his own accounting practice, an absolute wizard with the numbers.
Structuring is one of the most important things. If you're a sole trader running a business and you make $1 million a year, you're paying 500 grand in tax. If you're a company, you're paying 250 grand. I met with someone last week, potential new client, hasn't paid himself, he's been in business 5 years. He seems to have a really good business and I'm trying to work out, well, why? Oh, well, I didn't want to pay the tax on it. It's like, well, I don't know if that's really the strategy you want to be taking.
We had a client that went into administration and they had an outstanding debtors report of $306,000 with
That they owed you?
That they owed us.
Yeah, well.
And that was money that had been paid to employees already.
I don't see enough people really backing themselves. They kind of want this, but then they don't really want to do what's required to get to that. And that to me is one of the biggest downfalls I see, especially in micro and small business. I've seen businesses in the past that have been bootstrapped on a credit card and then they've got out 5 years later with 8-figure sale prices and things like that. So it can happen.
Welcome back to another episode of Two Blokes One Business with Harv and Calley.
Yeah, we're back again. Today we're sat down with, what would we say, Mitch is probably our high-level financial advisor at the moment. So he's the man where if this all goes tits up, it's Mitch's fault.
It's all on me. All right, I'll take that. I'll take the responsibility.
No, but thanks for coming on, mate.
Thanks for having me.
We're excited. Like for background, Mitch has got his own accounting practice, so an absolute wizard with the numbers. And this podcast is obviously aimed at aspiring entrepreneurs or people that are just starting out on that journey. And ironically, although I do recruit accounting and know enough to be dangerous, when we sit down with people like Mitch, we quickly realise we don't know much at all. And you opened our world. So we want to kind of take people on that journey of things to consider, how they can get started, the do's and the don'ts of the world.
Yeah. No, awesome. I'm excited to chat about it and get into it.
Yeah. I guess at a high level, Mitch, what is Wakefield Pacific? What do you do? Who do you help?
So Wakefield Pacific, we started it 5 years ago and we're really focused at growing businesses and not just compliance work. So it's really around taking people on a journey as well, from infancy, startup phase, right through to our biggest client will be doing $20+ million in revenue. And
That's not Harwell, by the way.
Not yet. Not yet. And we take them on that journey. And I really like to focus on working with clients, really pushing their mindset, really pushing what their goals are, really looking forwards. I feel like accountants do get a bad rap for kind of always looking in the past. And I think that's a little bit unfair on the industry, but you've got to be looking forwards, and people do get stuck in the day-to-day, especially startups. You're doing everything. You're doing the admin, you're doing the invoicing, you're doing the work. And it becomes difficult to kind of see what that next step is and what that goal is. So that's what I like to push on. And obviously the accounting side of things is our bread and butter and what we do well.
So cool. I think when we've sat down with Mitch and had the meetings, he loves the whiteboard.
Oh, mate, that gets me going, eh?
Yeah, when you see him reaching for the whiteboard marker, and we're like, here we go, strap in. But like accounting, like I said, I recruit accounting, and the stereotype is that it's boring and that it's boring people, if I'm not speaking too much out of term. And it's actually not. Like, we come out of those meetings with yourself when we're talking about business structures, where we can invest. And I'm like, to do that every single day and effectively be the advisor to all of your clients, like, that must be so fun.
It is. I love it. I mean, I really do love it. It does get a bad rap, I think, because the spreadsheets and software and bank account statements and all that kind of stuff, and that is part of it, no doubt. But really, what I do most of my day now is sitting with clients and strategizing about what's next for them, what's next for their structure, what are their goals, what's driving them forwards, because those answers really drive every other decision you're going to make from an accounting perspective or a business perspective. So if you're looking to grow really quickly, well, maybe we need to get a different structure in place. Maybe you need a shareholders agreement with your other owners of the business. Depending on where you're trying to go, we'll dictate our advice. So no, I love it. It's really exciting, and you get to work with so many different types of people. I'm working with e-commerce brands. I'm working with service businesses. Gold Coast is pretty heavy on the building construction industry as well. So work with a lot of different trade industries. So you get to see a lot of different things.
It's gold.
What would you say is your sweet spot? Because we recruit for a lot of different size companies, and some of those companies have one internal finance manager and lean on someone like yourself quite heavily, whereas some of those companies can have $1 billion turnover and finance teams of up to 40.
Yeah. So I guess the larger the scale of the business is kind of where a firm like ours and probably most accounting firms kind of step out, because it really does get left to a finance team where they've got multiple people in charge. Our sweet spot is, as I said, anyone from doing $500,000 in revenue up to $20 million, where they may have some support, and generally at the startup phase, it's, my wife's doing the bookkeeping or something like that.
Nice.
But it grows to having a GM or a CFO or even a fractional CFO. And we're just there to support wherever we really can. So we've got a bookkeeping department where we can take care of your books kind of day to day, your AR, AP, payroll, all that kind of stuff, right through to management accounts, monthly board meetings, things like that. So the service can vary depending on the industry, really, and the size of the business.
Love it. I'm keen to really dive into different points of the journey, right? So we're going to talk about business owners, and then this startup phase, and then they've got a bit of traction, and then even building kind of generational wealth. Before we speak, I guess, exclusively to business owners, let's say I'm a high-performing PAYG employee, right? I'm on a good wicket, or I make good salary in comms. I'm earning 150, 200, 250K a year. There's less flexibility in terms of what you can do, is my understanding. But if someone's in that boat, what are some things that potentially they haven't considered yet, where they can kind of maximize their bang for buck, or what should they be thinking about as they continue to grow in their career as a PAYG?
Yeah, it's difficult. If you're really good at what you do, but you're an employee of a company or even contracting to someone, you get caught either as an employee, so your income gets reported to the ATO every week through single touch payroll, and there's not much you can do about that. Or you'll get captured under like PSI rules or PSB rules, which is like personal services. So the ATO basically say, yeah, you could set up a company, but can't start paying your wife and your uncle and your brother, because it's just you and your skill set. So key things for those kind of people are, number one, you're always looking to max out super contributions, right? The easiest tax deduction you're ever going to get is maximizing super contributions.
Is that a bit controversial at the moment with what they're looking to bring in?
Definitely. It's hard to give advice at the moment, especially if your balance is near that $3 million. A lot of our clients aren't there. Our clients are definitely in that younger age bracket, so they're still building that up. So it's easy to give the advice. You know, I'm definitely sat with someone yesterday. They've got carry forward contributions to use. They're putting 150 grand into super this year. But it is harder to advise as you get closer. So super contributions, number one, and then depending on their level of wealth and I guess their ambitions and their goals with their wealth generation will dictate the next piece of advice. But generally, you're looking to get some sort of asset, investment property or something like that, and maybe look at negative gearing, you know, like that. Then if you're in the top marginal tax bracket, you negatively gear a property, it might cost you 20 grand a year, but you're getting half of that back at tax time. So it's really only costing you 10. And if that asset's growing 50, 60, 70 grand a year, yeah, it's costing you some cash, but if you're earning enough, you don't really need that cash. And now you've got this asset that's growing every year and it's capital growth. So things like that we look at, but it is difficult. It is difficult to really get some tax minimalisation strategies in place for high-level employees.
Let's talk about super, because that's one thing. We're English, so you don't really. I think you have pension schemes over there, but you don't have a legal superannuation. And I was probably always of the opinion, Ads is more so longer term thinking, and is probably a bit more kind of pro putting money into super, whereas fuck that, I want the money in my hand right now in short terms.
Totally.
But one thing that I learned recently was that, yes, you can put money into your super to save on tax, but then you can actually access that and invest that before you're 65 years old, whatever the point is.
Yeah, through like a self-managed super fund.
Yeah.
Yeah. So as you grow your super balance, generally we kind of sit here and go anywhere from $300,000 to $500,000 should be the starting point of when you look at setting up a self-managed super fund. But it is a way of accessing your super a little bit earlier and using it to invest. Really common in business owners to then access that super, set up a self-managed super fund, and maybe buy the property they use in their business. So if you're a trading, you need one of those man sheds in Burleigh. They cost 800 grand. You need to store some stuff, and you need a little office for your team. Perfect opportunity to go, I've got 300 grand in super. Let's use that as a deposit. Yeah, we can borrow money in super. But now I'm paying myself rent. Super's got that discounted tax rate at 15%. So there's really some good benefits there. But outside of that, the rules with super are pretty strict. It's got a lot of red tape. Unless there's some really like financial distress, you can access some super and other medical reasons and things like that. But the main thing we're looking at with clients, and I met another client yesterday, they've got an e-commerce business here on the Gold Coast. They need a bigger factory. They produce their own product here and make it.
More.
So they need a bigger factory, and it's number one, it's hard to find a factory the size that they need. But two, that's why we're maxing out their super contributions this year, because we're like, as soon as we're ready to buy and you find the right place, let's use the money in super, buy it in an SMSF, and then you're paying rent to yourself.
I love this stuff so much.
Can you do that as an employee as well? And with that employee debate, you could say you earn really well, like you're in that situation. Ad said you can actually access that super, buy a property. You don't necessarily need it for your team because you're just working for someone else, but you could then rent that out. And
definitely no rules on who can set up a self-managed super fund. I mean, there's clear rules on, again, you can't buy you couldn't go buy a house down in Byron that you chuck on Airbnb a little bit and then you and your family go there for 3 months over Christmas and New Year's. Like there can't be any personal use or anything like that. It's really strict. But yeah, commercial property works really well for the self-managed super fund kind of setup. But no rules on whether it's employee or a business owner. Employee could go and buy. I've got someone right now actually. They've been watching a lot of stuff. They've been learning a lot of stuff about investment. Their super's in stocks. They don't know nothing about it. They don't understand it. They understand property. But they're going to go set up a self-managed super fund right now, and they're going through a buyer's agent and buying a property, but they're just a salary and wage earner in their own day-to-day living.
In terms of typical results, right? So we bought a property, say individually half does now in his super, and obviously the capital growth and everything else for that. By the time he's 65, compared to leaving it in super, is it kind of night and day? The results obviously are subjective to the performance of the market. But
yeah, hard to say. I mean, ultimately, super was set up to help individuals grow their retirement fund, right? It was never used, and this is where the problem lies at the moment with super. The rules were definitely back in the 90s and the 2000s, there was less rules around it. So people go, hold on a sec, it's 15% tax. It's cheaper than tax I'm paying. I'm going to load up money into this super fund. And it's become this wealth creation strategy. And the ATO and the government go, well, that's not what it was for originally. So that's why they're trying to crack down on it a little bit more. But it's hard to say what the best outcome will be. Generally, I mean, for most people out there, it's generally going to be your super fund that you've got, your Australian Retirement Trust or your Sun Super or whoever's out there. They're going to charge you the least amount of fees because setting up a self-managed super fund is not cheap, right? So if you want simplicity, I generally say to people, just leave it where it's at. Make sure your fees are good. Make sure you're in the right kind of fund. So the younger you are, generally you want to be in a more aggressive, invested fund. And as you get older, more balanced and then more conservative. My phone's ringing. Sorry.
Oh, hang on.
$5
fine.
I'll take the fine.
Fine.
I'll take the fine.
We're not cutting this out either, mate.
No.
Yeah, good. I'll go airplane mode. Sorry, gents. Where was I?
super fees.
Super fees. Yeah. So setting up a self-managed super fund is expensive. You know, it's probably $3,000 to $4,000 to set it up. It's a couple of grand a year just to maintain it. So you want to, that's why I said you want to make sure you've got this $300,000, $400,000, $500,000 starting balance. Otherwise, you're just eating up your fees. So for some people that go to me, oh, my mate at the pub, he's got a self-managed super fund. I want to set one up. I look at their balance. They got 80 grand. Man, you're going to lose 10% just setting this thing up. It doesn't make any sense. Australian Retirement Trust is charging you 0.2% every year, and stick with them and let it grow a little bit. So it's hard to say what will be the best outcome long term.
Good politics answer that one.
Yeah.
Let's talk about the mindset then, right? So I'm this high performer, and I guess even talk about the journey we did. We did well at Hayes, made a bit of money, and then thought, great, let's go and do it for ourselves. What's the mindset shift that you've got to have from going from employee to business owner to really, I guess on one side, not get caught out, not fail, but then on the second answer to that, really maximize what you could be capitalizing on as well?
It's a good question because I see lots of different people in business, and especially startup phase, right? Like everyone wants to try and have a crack and do it themselves. And it is easier said than done. Like some businesses just don't work. And some people come in and go, I'm doing this, I'm setting this up. And I'm like, hold on a sec, can you just run me through this and how you're going to make money? And then pretty quickly, there's no money in this thing. So the mindset is, number one, you got to do your research. Like, is this going to work, right? So professional services like me, I charge an hourly rate. So I go, all right, as long as I got 40 hours a week of work and I can charge this hourly rate, I'm going to make some money. Okay, cool. So that was really my starting point when I started my business. It was like, I can work from my spare bedroom, got a few clients that like me. That's probably 20 hours of work. I reckon I can get another 20 hours. Cool, I'll make some money. Great. But at the same time, as you grow, costs build, things like that. So you've got to do the research. You've got to know kind of where you're going in that first 12 months. I think there's got to be some sort of, in the first 12 months, I'm happy with this outcome. But I think you got to back yourself. I don't see enough people really backing themselves. They kind of want this, but then they don't really want to do what's required to get to that. And that to me is one of the biggest downfalls I see, especially in micro and small business. Like people just almost think, well, if I start a business, I'll just make more money and it'll just happen. And it's like, it doesn't. You've really got to do the homework. You've really got to know what you're doing, who your market is, how you're going to get in front of the people that you need as a client with or a customer if you're doing e-com or retail. Hospitality is a big one. You know, I'll just open a coffee shop and I'll be right. Like, you probably won't be. Like, coffee shops are tough.
Competitive.
Yeah. It takes me back to the process me and Ads went through when we were in that situation with our, last employer, and we were working out, and it was really that kind of back of the napkin sums. And I think we worked out like the last financial year that we worked for our ex-employer, between us, we billed, I think maybe 1.3 million in commissions for the business.
Yep.
And I think out of that, our salary between us both, I think the salary component would have been maybe 350 grand. Ads did more than me, so his would have been higher.
Sure.
But we sat down and we're like, okay, so we did 1.3 mil. Can we go and take, we earned 350 out of that 1.3. Do we back ourselves to go and fill 25% of the jobs that we filled with our last employer for ourselves? Because we're like, that's the baseline we need. That's what we lived off last year. That's what we can live off this year.
Yep.
And when we decided the answer is yes, I think we did the same as you. Here's 10 clients that I know are going to come with us. And off those clients, I can fill 15 jobs each. There's the money. And that was enough to make us go, we've got enough to go for ourselves. And then when you actually make the leap, because you're driven and you get the confidence, we did the same. I think it was exactly the same. I think in our first year in business, we did 1.3 mil GP, just the two of us. And at the start, 12 months ago, we were like, if we can just do 25% of this. And it's that mindset shift of looking at the figures, even just at a high level there, to give yourself the belief, as you said, to actually go and do it. Because that's the hardest thing, is just making that jump. And I look back now and I'm like, wow, if we didn't, life would be so, so different.
Totally. And same for me. And yeah, I think you hit the nail on the head there. You don't have to do a hell of a lot of back end work and research, but do a little bit to go, okay, if this happens, I'm good. What is the absolute worst case scenario that I'm okay with? And then am I willing to risk what I've got to potentially get that? And then the rest is kind of cream in the first 6 or 12 months. But, and especially with tools like ChatGPT these days, like it's not hard to go, right, I want to do this. I want to earn this amount of money. My costs are going to be this. What revenue do I need to do? Oh, okay, cool. And I think for a service-based business like what you and I do, in terms of you're dealing with people and you're not selling time as such as we are, but it's the same thing. You're getting paid based on the performance that you do. It's a little bit easier to build that business, or at least start out on your own. But use a coffee shop, for example. Like if you haven't done a bit of research to go, how much foot traffic am I going to get? What are my wages going to be? What's my cost of sales? Okay, hold on. I'm only left with 30% of every dollar I bring in after paying wages and my cost of goods, like rent, insurance, this. Quickly, it's like, this doesn't work.
Yeah, or you need $1 million revenue in year one.
Yeah, and I'm signing a personal guarantee for a 7-year lease, and like, there's a lot that can go wrong in a business like that, or a lot of different businesses. So I think the homework is so key, and it gives you that drive and that confidence to go, I can do that. And I think that helps a lot.
On the other side of that then, so a lot of people, it's the motivation to actually go and do that, and a lot of them do quite well. But what about the people that probably do it a bit blind and have that emotional fear almost of, they've started this business, they've invested whatever they might have, they've not done the figures enough, and they probably know deep down it's not profitable, but they want to just ignore the figures and they just let things kind of spiral before coming to speak to someone like you. Do you find a lot of people in that position?
Yeah, like there's definitely people that think they're performing differently to what the numbers show, and you got to go off the numbers. The numbers don't lie ultimately. It definitely happens from time to time where people have this false sense of what the business is doing, or just in terms of what the future holds for them. They've got this, it'll be right, it'll be sweet, and it's like, well, no, it won't be. Like, you're gonna, in 60 days' time, you're not gonna have any cash left. You've already got ATO debt. You haven't paid your last BAS. This spirals very quickly. Oh, just get a credit card. No,
I was just thinking about that.
Totally. But then on the other hand, I've seen businesses in the past that have been bootstrapped on a credit card with really again, I think this will work, but balls to the wall. I'm going to go in on this and I'm going to see what happens. And then they've got out 5 years later with 8-figure sale prices and things like that. So it can happen. But again, they would have had some inkling of there's a market there. I'm targeting these people. My costs are going to be this. And the revenue might take, if you're in construction, it can take 90 days to get paid. Okay, if I bankroll this for 90 days, I'll get paid then. And it can work. But you've got to do that little bit of homework. And I just see a lot of people just don't do it.
And probably the problem is because of those success stories of old mate who did it on the credit card, had a crack, it paid off. It gives people a bit of false confidence that actually that is a good strategy. We should be doing that rather than potentially being a bit more conservative. Do your numbers, get a runway. I know we saved up kind of 20, 25, 30K each before we started Harwell.
Yeah.
Okay, that's about 3 months worth of expensive, where if we don't bill a single cent, we can still feed my dog, feed Harvey's kid, and we can be okay. So do we back ourselves to make money in 3 months? And we did. If you don't, should you be starting the business anyway? Is probably the question I'll be asking.
Exactly. And when I started my business, I sold two units that I owned to have some cash and to have less outlays. And I'm like, if this doesn't work, I can pay the bills, I can do this, I can do that. And all right, worst case scenario, I'm a chartered accountant, I'll be able to find some work. But it worked out. Never really had to sell those properties. They're probably tripled in value.
Yeah,
I don't talk about that much. But I'm joking.
Self-made superstar.
Yeah. But the business, if you didn't start the business, where would you be? So yeah, I think it's important to have that safety net. And some people go, well, it's going to work anyway. No, I think the safety net helps you just go, okay, I can lean into this and I can go all in, as opposed to tiptoeing in and, well, I've got this mortgage and I've got a couple of kids. I can't really do it.
It'd be a bit desperate as well.
It's hard.
And if you know you need to make this sale, that energy comes across on the phone. It's more for you actually rather than it is for the solution you're trying to solve.
I agree.
One thing that's quite interesting to me, it's the people that are probably a bit more switched on to the numbers and have those thought chains before starting a business that are probably the ones that maybe don't actually do it, whereas they're the ones that should do it because they're already thinking like that, whereas it's the people that go in completely blind and this will work, and they're the ones that do pull the trigger and it doesn't work. And I'm trying to think what people can take away from this. I know that one thing me and Ads do when we make any investment decision in the business now, we have what's the release valve. So we're looking at the moment of bringing 2, potentially 3 new staff on and really building a structure in the business that releases me and him to be actual founders, to go and generate more high ticket relationships to pull money back through. And when we look at new staff, we go, the release valve is in recruitment, we feel after 12 weeks, they should be bringing in revenue that pays for themselves. So what do they cost for that 12-week period? Say it's 20, 30 grand, whatever it is. Okay, our release valve on each member of staff is 30 grand. Are we happy to invest 30 grand? And if it doesn't work, it goes down the drain. But if it does work, these are the potential rewards. So that release valve we use on every decision, not just staff, but other things as well. And if you're comfortable with that release valve, and it might be starting a business where you go, my release valve is I sell a property to keep things moving, or I'm a chartered accountant. I know I can walk back into any public practice I want. If you're comfortable with that release valve, there is absolutely nothing stopping you making that plunge.
That's exactly right. I think it's such a great thing to have is to go, what is the worst case, or what am I willing to invest here in time or money, and know that I'm okay with that scenario. I have a lot of people that hold back on the next stage of growth because, I don't really want to pay for another staff member. It's like, well, hold on a sec. Your goal, you're telling me you want to make $8,000 a week, which puts you in the top 1% of Australians earning that much money. But you're in a service-based business, but I don't want to hire any more staff. It's like, something's not right here. If you're not willing to put that money back in and know, I'll spend this, I'll go get more work, I've got to get this much work to pay that, then how are you going to keep growing? So it's a great example of having that release valve to go, we're willing to put this in. We know the risk that if this does not work at all, worst case, okay, we spent 30 grand. But if it does, and we go find 500 grand's worth of work that can fill that chair, happy days.
Great decision. That probably leads in quite good to this next kind of phase, right? So I was a high performer. I've started a business. We're 2 years in now, or 18 months in, whatever it needs to be. what are some of the things we need to be getting in place? And obviously one of them we've been speaking to you about recently is we had the shares of Harwell held in our individual names rather than a trust. And we might be losing a couple of people here. So if you can try and dumb down your answers, I'll be able to learn some of that. Why do we need to do that? Why was that important for us?
Yeah, so structuring is one of the most important things, if not the most important thing to do, because it's number one, it can save you thousands, tens of thousands, hundreds of thousands of dollars in tax if you have the right structure. If you're a sole trader running a business and you make $1 million a year, you're paying 500 grand in tax. If you're a company, you're paying 250 grand. So just having a different structure saves you $250,000 every year. So why it's important to review the structure. So for you guys, for example, if you're paying out dividends from your company, it's going to you guys individually. You're at the top marginal tax rate, 50%. If it goes to a trust, as I said to you guys in the meeting, there's no guarantee that I'm going to be able to save you some tax, because if you don't have anyone else to distribute to through your trust, you're going to still pay that tax rate. But it's like almost like an insurance policy. It's like giving you the option, if my wife's not working that year, I might be able to distribute some of the dividends to her at a lower tax rate. Maybe we get a bucket company set up, park some of the profits in there, and we start using those profits to invest in other things, or even send it back to the business through a loan or something like that. So you've got to constantly reviewing that structure. Companies are great, fixed tax rate, number one, so 25% for small businesses, but also separate legal entities. So the big one we do is sole trader walks in, making a couple $100 grand. In construction, especially, higher risk. And a lot of the time people haven't reviewed their insurance and they might not have the right insurance in place. So the first thing you do is, let's get a company in place, protect you and your assets from this business. And then a trust is not so much, it helps from asset protection, but it's flexibility. It's flexibility. It's not fixed ownership. So a company has fixed ownership. If you're the shareholder and dividends coming out, you're paying the tax. But if it's a trust, it can go to different people depending on who's written into that trust deed as beneficiaries, and can save you a significant amount of tax.
You touched on it a little bit there, and it's separating your business finances to your personal finances. And that's something that obviously a journey we're going through as well, because you see the horror stories in the news that, Mr. Builder over here, massive construction company goes under, and people are like, oh my God, everything he's worked for over the last 20, 30 years just crumbles. And I'm sat there thinking, no, he's got so many assets somewhere in the world, in his wife's name, his kid's name. Like, he is going to be absolutely fine. But can you give us a bit more light on that and how people can be clever and I guess protect their own house, for example, against the business?
So let's use the typical tradie, right? Like, sets up an ABN, has already bought a house, might have a couple of kids, so he's got a mortgage, he's got a house, especially on the Gold Coast the last 5 years. That house now has a fair chunk of equity in it. It's gone up in value. And he's running a business to his ABN. And he gets an email from his insurance provider, forgets to pay his insurance. Something happens on site. When you're a sole trader, you are the business. So you get sued or something happens to you in your business, they're coming after you to pay those bills. And if that means your house has equity in it, you're going to have a problem of having to maybe deal with that and take some money out of that house or sell that house to help fund whatever problems that you're starting to have. Setting it up in a different structure protects you, number one. Doesn't always protect you, but it protects you generally if the business genuinely just doesn't work or fails. Different if I've ripped all these profits out, haven't paid the ATO, and I've bought a couple of investment properties. Like, that won't work. You'll get caught there. But genuinely, if the business fails or something happens in it, then someone's suing the company. They're not suing you. And as long as you've acted in the best interest of the company as a director, it's very hard for them to come back to you personally and take your assets to help fund that debt. So structuring, so important.
I remember when we, obviously, multiple stages throughout this journey, me and Ads have fully put our nuts on the line here and gone all in. And the one decision we made at the start was that the business was structured in a way that our personal assets, Ads has got a house, I've got a house. The only reason I own part of a house is because all the hard work my partner did when she bought a house when she was 19 and sacrificed. And I was like, that has to remain protected, because that's not my money to put on the line. As much as I'm on that mortgage now, it's all of her wealth and assets. So that was one thing that we did from day one. And that would be such an important piece of advice to anyone started a business and is an ABN to potentially make that shift.
Definitely. You got to look at it. There's some more costs that come along with it, no doubt. So, if someone's making 20 grand a year in a side hustle, I'm not suggesting them to set up a company. But if you're starting to get to $130,000, $150,000 a year in profit, that's kind of the tipping point from a tax perspective where it really starts to make sense. Or if you're in a high risk business, construction, even advice, so like accountants, we're giving advice. I get that wrong. Cost you $100,000 in tax. I gave you the wrong advice. You're going to be like, hey, Mitch,
knock, knock.
I'm not paying this bill. Like you can pay it. So again, when you're in a higher risk business, you look at that structuring earlier.
Yeah.
Gold. And as we've been growing, cash flow is the word that everyone's, kind of warned us about and making sure we've got the money to achieve the growth that we keep talking about and keep going and doing. So what are some of the main mistakes you see early stage founders like we were or in different businesses make when it comes to seeing, the money they're invoicing out to their clients and then actually managing cash flow internally?
I see a lot of mistakes. The starting point is it happens a lot where you start a business, right? And there's more money in your bank account than there's ever been. Even at the start, it might be a $20,000 invoice gets paid or a $30,000 invoice, and you're used to $2,000 a fortnight dropping into your bank account. Oh, I've got this cash here. And, they forget GST. You got to pay your own tax now. Maybe you've got an employee, you got to pay their super and their wages tax, but you don't have to pay it to them right there and then. So that's due in another 8 weeks. And they forget about it. And then they take that money and then there's a new jet ski in the driveway and I'm going, hey guys, Bass is due. And they go, oh, what? Like, what do you mean? I thought I'd paid everything. So very common to see people take a bit too much money early days. The other problem I see is just over-capitalizing or over-investing in something or a part of a business that just doesn't work. So that can happen a lot. But cash flow is the lifeblood of the business. You've got to have that check every couple of weeks, every month to go, where's my cash gone? If I don't have any cash, where is it? Like, happens all the time. I'll get a call. I've got no money. Like, I don't have any money to pay the BAS. Okay, cool. Let's have a look at where it is. So anyone that's running a business, you'll have a profit and loss. You'll have a balance sheet. Profit and loss obviously tells you how much money did I make last month. The balance sheet shows you the movement of where that money's gone, right? So where is the profit? In a really simple world, if you make $100,000 last month and you had $0 of $0 in your bank at the start of the month, you might have $100,000 at the end of the month. That's not always the case though. So let's say you've made $100,000. I'll just use that because it's a nice round number. $80,000 of that might still be sitting in your client's bank account because they haven't paid you yet. On your profit and loss, it's showing I made $100,000. I only got $10,000 in the bank. Where the hell is it? No one's paid your invoices yet. You're invoiced on the last day of the month. They're 30-day invoices. You're not getting paid for another 30 days. Your profit and loss is going to show profit. So that's quite constant and quite consistent in people going, where's my money? It's out there. It just hasn't been given to you yet.
We learnt a big lesson early on, didn't we? Again, it's that mindset of thinking like an employee to thinking like a business owner. Well, as we were cash flowing growth and new staff, we would look at our receivables report as if it was our bank account. I think would probably be a good way to describe it. And sometimes project growth and investment based on those figures. What we quickly learned, and it was a harsh lesson, that we had a client that went into administration and they had a bill or an outstanding debtors report of $306,000.
That they owed you?
That they owed us.
Yeah, wow.
And that was money through a labour hire agreement that had been paid to employees already and supers and insurances and stuff like that. So it wasn't the permanent recruitment side of things where we just lose our time. The partners we'd use has physically paid out that money. Now, that was a very quick lesson. We didn't have to absorb the entire $306,000. It was us as well as an external provider that had to absorb that. But I think we were only not even a year in maybe, or just approaching a year in, and we had to take a hit of $90,000, I think it was, that we thought was coming into our bank account.
Yeah.
So that was a first lesson to us around cash flow.
Yeah.
We would grown and projected growth quite conservatively anyway. Like we always kept a bit of a buffer in there that we were able to absorb that. Yeah. But it was a quick lesson where I was like, you said about the jet ski and the drive and the BAS payments, you only have a couple of BASs you forget about, and then a 90,000K client goes under and you go, we're done.
Exactly. It happens really quickly. So it's really important to keep your finger on the pulse of where's my cash, when's it being paid to me, but also what commitments do I have, what's going back out the door, and what's my net cash going to be. Especially this time of year for us, tax planning, we're doing that a lot to go, all right, we're expecting you to have this much profit. June will happen like this. You've got all this money going out. So just remember that your free cash at the end of June is actually this much, not this much. So it's important to look at.
You've already explained the kind of big three reports that we wanted to go through. It was like your profit and loss and your balance sheet and cash flow. But what about looking at metrics that matter early on in business? Because we've learned that we have two different business units effectively. We have the permanent recruitment, which is highly profitable, time intensive is the risk, whereas we have the labour hire business, which in terms of the actual revenue that goes through that business is massive, but the profit's a much smaller percentage. So it's getting sucked into the vanity metrics of going, our labour hire business is turning over $6-7 million a year, which sounds amazing, but realistically it's only a fraction of that comes into the business.
Yeah.
Hey guys, thanks for tuning in to another episode of the Two Blokes One Business podcast.
Now, apart from being world-class podcasters, we also run a recruitment agency called Harwell.
If you're keen to learn a little bit more about what we do, then head over to our Instagram at Harwell Group and check us out.
Back to the app.
Metrics, depending on the business, right? So you're looking at a professional services firm. Let's use accounting again. My biggest expense, wages, right? So I've got to factor in what my wages are as a comparison to revenue. So what metrics do I look at? I look at revenue as a percentage of obviously wages, number one. How much revenue are we doing per full-time employee? That's a good metric to know. Maybe what's our average hourly rate? So we're charging by the hour, so to speak. So I've got admin staff that probably aren't billable. I've got high-level accountants that are highly billable. I want to know what my average rate is because we've got to kind of cover the admin costs. So that's for a professional services firm. Same for like legal and things like that. Very similar metrics. Then you're looking at the complete opposite of like an e-commerce brand, right?
Yeah, your product guys.
Yeah. What's my customer acquisition cost? What's my return on ad spend? What other things are you looking at? You're looking at your stock levels. You're looking at stock. That's big.
Lifetime value be a huge one for those guys.
Absolutely. Then what are you looking at? Coffee shops. You're looking at wages. Wages are huge for coffee shops. I'm talking all the time about if you can cut one staff member a week from a coffee shop, that's huge in terms of like the margins. So QR codes and things like that. You're looking at how many customers are walking in, foot traffic, things like that. It doesn't always have to be financial. You need to be looking at operational kind of metrics as well. But you want to be looking at, you can kind of go too far into data and there's too much information, and you want to be looking at data that helps you make decisions in your business. So if my wages are too high compared to my revenue, well, then maybe I'm looking at having to reduce my wages somehow. If my coffee costs are too high compared to the average cup of coffee, probably can't cut the cost of coffee. Like it probably is what it is. Maybe I need to up my maybe I haven't put my prices up for my coffee for 3 years and I'm the cheapest coffee on the Gold Coast. All right, let's be more competitive with our pricing. So it allows you to make decisions.
And there'll be different kind of industries or trades that have to plan for that very differently. Like even I'm thinking now as a tradie, you have the aspect of you are billing hours or you're pricing up a job. But even as a trader, you have quite high overheads with the amount of tools you have to buy, your ute. Even a lot of tradies will be actually buying the product they're using on site before they get their invoice paid, compared to recruitment. When we started this business, it was me and Adam. We needed to spend $2,000 on a laptop, a couple of subscriptions of like a CRM, which has a mobile phone integrated into it. Our monthly overheads is a one-man band, bugger all. So it's so easy and different for different people in different industries to go, okay, I can set up tomorrow. And we knew day one, let's set up. If we got one invoice paid in the first 30 days, we could pay ourselves equivalent of our salary. Whereas if it was day one, we've got to take on this job that's a 30K job, but we've got to then pump another 10K into actual materials and then do the labor and wait to get paid. It's such a different
ballgame.
Yeah. Construction's hard. Like, on the Gold Coast, it's obviously a pretty dominant industry on the Gold Coast, growing city. It's a hard business. I sit down with a lot of clients and they go, I've been doing this for 5 years. I still don't have much cash in the bank. What is going on? And the problem is you finish your job, your margin might be 10, 12, 15. The good guys might be getting 20, 25%. But you've already started the next job. You've rolled that profit into that next job. And then you got to wait 30 days to get paid. And it's like a never-ending cycle. And with my construction clients, I always say, all right, like it might feel like you don't have cash and you don't. But if you close the business today and everyone paid you what you owed, you paid all your expenses, would you have cash in the bank? Yep. Okay, let's do those numbers. Yes, we would. Okay. So this thing is working. There is profit here. You're always just using that profit to fund the next project. And that's why it's so important in construction, for example. You've got to be doing really detailed, like how much money are we making on this job? And what a lot of people miss in construction is the fixed cost behind the business. What does your insurance cost? Because you're just looking at materials and labor and you've got this 15% margin, but hold on a sec, you got insurance, you got accounting, you've got, other bits and pieces that just it costs to run that business. And then all of a sudden there's no profit. Happens a lot.
In terms of a safety net, what's the right amount of cash to have in the bank to go, great, that's parked away, that's a 6-month run-in or a 3-month run-in? What's, I guess, conservative to be safe, knowing that if you slow down, you can still keep the business running and not be too stressed out your head?
I would say conservative is 6 months. And like I haven't checked these numbers, but I'd be pretty confident to say that we deal with 200 client groups, maybe a touch over 200 client groups. Less than 10% have 6 months runway. Yeah, especially in small business. It's tough. You're constantly chasing the cash. It's going back out, especially trying to grow.
Yeah,
you've got to reinvest. We've got a couple of businesses that just thrive. They're just really solid businesses and they've got plenty of cash in the bank and they can invest and do all these things that they want to do, but it's not typical. A lot of people are struggling. They've got maybe a month's worth of cash flow or 2 months of cash flow, and then bills come in and I forgot insurance was due. We're coming up to work cover and I'm dealing with a demolition company at the moment whose work cover bill next year we're estimating to be $100,000. And that's going to come due in July, August.
Yeah. One little trick we've got, we do it with the tax money, and we're going to start doing it with profits. Like, this is all above board. I'm just laughing, going, oh boy, fuck, what's he going to do?
Oh dear.
We park, when we have big sums, because we put our tax money away every single month. When we get a sizable sum in that account, we just park it on our mortgage offset accounts, because then effectively we forget about it. Yeah. And we're saving money at the same time.
Yeah, nice.
Am I allowed to say that on air?
Pretty common. No, you can say it. Absolutely.
Mitchy's like, no comment.
No, very common. Very common for people to do. It gets a little bit where people get caught out is if they don't get the money back into the company, because you're borrowing company money. So you've got to get that money back into the company to make sure you don't have a director loan and have to deal with Division 7A. So, but it's very common. And it's kind of advice that we do say, like, put the money in your offset, save that little bit of interest, but just remember that it's not your money yet.
Yeah.
If you want to use that money and go and buy, like, if you're making enough money and you've got this free cash flow and you want to go buy a boat or you want to take your family on a European holiday, that's cool. There's just some things we need to do to actually make that money your money, because until then, it's not yours, it's the company's.
Yeah. This is probably going to show how naive we are, but so far it has actually worked. So every time we get
any savings plan works, right? Like if you've got a plan, I do it in the way, and I tell a lot of clients to do this, where I just work out roughly the average BAS is like the average BAS bill as a percentage of revenue is X. All right, every week, just set up a direct debit to your savings account for that amount. If it's $5,000 a week, let's say your BAS is roughly $20,000 a month. If it's 22 or it's 19 or it's 24, you've got 90% of the money saved. You just need to dip in a little bit more to find the rest, or maybe you've put too much aside and you just tweak that every 3 months. Set and forget. Like, that's the big problem, is just put it aside, almost like that pay yourself first kind of thing. Like, get that put aside first and know that the money in the bank is free cash flow.
I've taken it upon myself to be like the money man.
Yeah.
So whenever we get an invoice paid, I'll just move like 25 to 30% across the tax.
Yeah.
Just black and white. And I've just got feeling. Sometimes it's 25, sometimes it's 30. And the name of the game is then when we get the end of month report, it goes, great, you should have $100,000 in your tax account. We're like, bosh, we got 110. So we made 10 grand.
I think, like, I mean, you laugh and go, oh, I'm kind of the money man. But I think when you, like, this is advice I give a lot of people when they're in business together. Having your own jobs, like in the business, is actually really important. I don't see enough people do it. There's no communication between business partners of who's responsible for what. And that can cause some serious problems. If no one's doing that, then you get to the end of the month and go, oh, isn't that your job? Whose job is that? You can get caught out. It's really common where business partners don't sit down enough and go, you're in charge of this, you're in charge of this. Having management meetings or like director meetings to go, this week, your job's this, your job's this. All right, cool, we're good. See you next week. And it's accountability. So it's uncommon for people to have these clearly defined roles of, I'm the money man, you're in charge of the people, or whatever the case may be.
It
Stick
works.
to your strengths.
It does work. And like one of my jobs is I read the P&L.
Yeah.
This is good. You're like this. It got about 4 months ago and I was just like reading through the P&L. I was like, mate, have you seen that on the P&L? He goes, what? I was like, have you seen that? I was like, oh, wait, hang on a minute. I was like, do you ever read the P&Ls? He's like, nah, because you do. I'm just like, yeah, that's fair enough. What if I'm doing it? Like, why would you waste your time?
Yeah, you've got to be. Someone's got to be doing it.
Yeah, I think again, not good advice at all, but as long as I know we've had a really good month and build, I'm like, work yourself out.
Yeah, that's good.
That's why you should do business as a partner. Split up the roles.
Yeah, the work itself out maybe is not the comment I'd use for most people, but
No.
yeah, I think you're coming back to the 3 key reports: profit and loss. How much do we make? That's always, you got to know that. Have we invoiced enough? In again, professional services, if I haven't billed, I've got WIP in the bank, right? Because I've done this work, but I haven't billed for it yet. What did I make this month? Where has that profit gone? So if I haven't been paid any money yet, it's in my client's accounts. If I've been paid some money, maybe I had to buy 4 new laptops this month. Okay, I made 50 grand, but I have to spend 10 on new computer equipment. Like, where has the money gone? And then that's leads into like a cash flow report. I think the profit and loss and the balance sheet are the starting points. The cash flow report can be a little bit confusing, but there is good reports if you're using some accounting software out there. It just probably comes down to like how good your data is. Like shitty data in generally means shitty data out.
Yeah.
So you want to make sure your bookkeeping's on point. We do our bookkeeping for all our clients weekly, so it's constantly getting done. And then that quick phone call, hey, what was this? What are you doing here? What happened here? We're also picking things up quickly. Oh, they've bought a new car. We can see a new loan repayment. Right, we need those docs. That's a GST adjustment. Cool. And we're on top of things. So doing your books regularly and well is important to getting that data back out of those reports.
And one thing I know that we did early on as well, which I think worked really well, so it is a good lesson to anyone really just starting out in business. Our first few clients or invoices, we would try and agree really favourable terms in our favour, and not to try and do them over or anything. We were just honest. The first few clients we worked with, we were just like, hey guys, whilst we've got experience doing this elsewhere, this is one of our first jobs that we're actually working on through Harwell. We need to start paying ourselves. Can we do 7 days payment terms from contract signing? Nothing happens to your guarantee period, so you're still protected. It just helps us with a bit of cash flow through the door.
Totally.
And you know what? When you're that honest and open with people, every single one of them said, 100%, get it through. And they pushed it through. I'm lucky that my contact for the recruitment is normally the person paying the invoices. So you're able to just keep on top of them and they fire it through.
I think you hit the nail on the head. Communication's key. There's no rules in business around you have to get paid 30 days after invoice. Like generally with our clients, we've now got them on fixed monthly retainers. So you go, this is what you're paying us for. It comes out every month. You know exactly what you're getting. If something happens on top of that, you'll get a separate invoice and a separate engagement from us. It's communication. You communicate with the people. They'll generally be receptive to that if it's upfront and honest and go, hey, we need to get paid a bit quicker. Look, if you pay us within 7 days, we'll knock a couple of % off the invoice or something like that. Yeah, there's no rules. So communication is probably the most important thing in business. I'm sure you can agree.
That kind of leads into another thing we've got down here, and it's when to do it yourself and when to actually bring in someone. Because one thing that we found is as we started to get a lot busier as founders and business owners and as a business in general, your receivable report comes through on a Monday and you're like, oh, fuck it, we'll leave it. We'll do it next week. And then quite quickly you're going, okay, the receivables report is huge, or I haven't sent my invoices out. So at what point do you think a new business should come and use a Mitch Calley for your bookkeeping?
I guess it's not a one size fits all. It really depends on budget, number one. Time and budget. So very common and we do sometimes encourage it to like, hey, learn to do the bookkeeping. Like learn how Xero works, learn how to reconcile a bank account, learn how to do payroll so you're familiar with it. I think it's at times important, especially at startup phase where you're like, look, I don't have $400 a month to pay you guys to do my payroll and my bookkeeping. Like, okay, cool. You're going to have to learn to do it yourself. But there does come a point in time where as founders and as directors and as the business grows especially, you can't be doing that stuff anymore. I don't do my payroll anymore. I don't do my bookkeeping anymore. Even though I'm an accountant. I don't do the AR, I don't do the AP, I don't look at any of that anymore. I look at it once a month in the report, but I'm not looking at it day to day. But there comes a time where you go, oh, I could be doing much better things right now for the $300 or $400 or however much it's going to cost to get that done by a professional. I know it's taken care of. I know it's dealt with. I don't have to worry. So startup phase, we get a lot of inquiries from startups like, hey, we're starting a business tomorrow. I need an ABN. Okay, cool. You'll probably need some accounting software. Okay, cool. Can you set it up for me? Yeah, we can. It's X amount of dollars. I don't have that much money. Okay, that's cool. Here's a YouTube video on how to do it.
Yeah.
Here's a Xero course online for free to learn how to bookkeep. Let us know when you're ready.
Yeah.
And I generally think if someone's not willing to put that little bit of energy in,
It's not going to work as a business anyway. Yeah,
it's a bit of a red
Struggling.
flag.
Yeah. Yeah, that's it.
With the tech stack, Xero is obviously the one everyone knows and uses. Anything else that if I'm a founder, we starting hard, well, great, we need to go and do our own bookkeeping. We've got no idea. We were just PAYG employees. Other than Xero, anything else you'd recommend to get set up?
These days, I think you need some sort of receipt keeping app. So there's a free one that comes with Xero, which is called HubDoc. It's fine. It does the job. Then there's like a next level step up, which is called Dext. So something like that to you're on the road, take your photo of your receipts or scan it in at the end of the day, or you can just email it directly to there. Then it helps with the bookkeeping because your GST calculations get automatically done by the software, things like that. Xero Payroll does its job as well, but if you have specific industry payroll issues, so like hospitality, generally there's like a timesheet app, and then it feeds into Xero and kind of pre-populates the payroll. And then it really depends on industry and I guess how big and what you're going to do. So we use a software in our practice called Ignition, which is our engagement software, and it direct debits the money every month for the clients that have agreed to the terms. And I'm actually introducing that to a client of ours that runs a cleaning business at the moment because one of his small margins, right? So you've got staff that are getting paid $45, you're charging $60 for a clean. So your margins are tight. So you need to get paid. And he has couple of invoices every week that don't get paid. I said, mate, look at something that's automatic invoicing where you press a button, the client agrees to it, takes their money, and you get rid of this debtor issue. So depending on your industry, there's plenty of software out there to help you do certain things. E-com, there's things that feed in and get your export. If you're sending 80% of your stock overseas, you've got to get your GST calculations right and things like that, or stock management as well. So industry specific.
Gold.
Yeah, and there's definitely some industries, like I know e-com, where it's direct to consumer and you pay when it's in the basket online before you receive the product. That's a great kind of cash flow.
Yeah, right. Like
business.
e-com don't have those cash flow problems that construction have.
But they have the inventory battle then.
Correct.
Oh, shit, I'm sat on 1,000 t-shirts that I can't ship.
I'm sitting on...
And I've got $300,000 of revenue tied up here.
I've got a local business, probably the biggest Southeast Queensland in what they do. They're sitting on like $1 million worth of stock. And retail's tough at the moment. Yeah. So I'm saying, guys, you've got to move this stock, And it's tough at times, especially in small business as well, because the guy that's running it, he's not a business guy, right? He's passionate about what he sells and what he does. He's been doing this his whole life. So he sees a great deal on this new piece of tech that he's selling. He goes, our clients will love that. It's like, okay, maybe let's just push the stuff out that we've got now, and that can wait. Yeah. So you're always dealing with those problems as well.
What about the idea of bootstrapping and then potentially borrowing money to start your business? Because we bootstrapped it, which I think we choose every day of the week. I think it gives you that level of seriousness. Every dollar actually is your own dollar. You're not just using someone else's money. It's not monopoly money. Obviously there's certain businesses, if they want to scale, I know like Jackson Frank Creef at the moment are going through their journey to $1 billion.
Those boys.
And they've openly said this time they are going to go and get seed capital so they can scale way quicker rather than bootstrap it. Is there a right or wrong, Mitch?
I think there's probably definitely a wrong where you're taking on debt or investors where, again, you're trying to grow something that maybe you haven't done the homework on. But if there's a real clear scale to growth, then I think it can work. Doesn't always work, right? Things don't always go to plan. I bootstrapped my business. As I said, I sold a couple of properties to get it done. Most of the clients we're dealing with are bootstrapping it, right? Where that changes if you're buying an established business. So, I've got a client, e-com space right now. He's sold a few of his businesses, a few of his stores, and he sold them for good money because they're making good money. And I know the people that were buying it had finance clauses in the contracts and they've got to go maybe borrow against their house. But if they know that they're going to get that paid back in the next 3 to 5 years, sure, that makes sense. Yep. If you're building something, you're buying something that's established, there's really not too much of a chance that it's not going to work anymore. So that at that point in time makes sense. If I was going to go buy $1 million worth of accounting fees tomorrow, I don't have $1 million cash sitting in the bank account. I'm probably going to go fund that and get some debt and pay that off over 3, 5, 7 years, something like that.
Love it. Next one we've got, mate, is talking about how and when to pay yourself and the best ways to do it.
So I'm a big believer in pay yourself first, and I'm a big believer of pay yourself fair. So it's very common to underpay yourself at the start. I met with someone last week, potential new client, hasn't paid himself. He's been in business 5 years.
Wow.
Never paid himself.
How's he living?
He's got minimal living costs, he tells me.
Don't ask.
Right, but never paid himself a wage. And he seems to have a really good business, and I'm trying to work out, well, why? Oh, well, I didn't want to pay the tax on it. It's like, well, I don't know if that's really the strategy you want to be taking. So you've got to pay yourself first, and you got to pay yourself fair. I can't go and pay myself $1 million if I can't go get $1 million working for someone else. Pay myself what I'm fair in the market, because you want to show actual profit at the bottom. If I'm taking all the profit as a wage, and where's my profit? You've already taken it. Yeah. You're kind of skewing your figures a little bit. So that would be number one, pay yourself first and pay yourself fair. The structure around doing it really depends on your kind of business. If you're running through a trust, you could do like trust distribution, so you don't have to pay super. You don't have to run through like a payroll function. That's completely legal. You can do that. Just draw money out at any stage throughout the year. You pay the tax at the end of the year. If you're a company, you can't do that as much. You could do dividends if you've got retained earnings and franking credits, which are tax credits. But generally speaking, we put people on wages. Pay yourself a wage, pay your super, your tax comes out in the BAS. And then again, you're looking at a real profit number at the end of the month or the quarter or the year. And if you're a sole trader, you actually can't put yourself on payroll. You can't pay yourself because the ABN is you. So you just basically take money out and pay tax at the end of the year.
It's Harwell paying Harvey and Adam.
Correct. You guys are a company. Yeah, you guys are a company. You're employees of that company. You pay yourselves your wage for the work that you produce, right? And then the profit is the profit of the business.
One that has come to mind, like a live example, is we pay ourselves obviously a salary now. Now we've been in business a couple of years. We've got franking credits, which is a fun one to learn. And we got stuck into that.
Good old Frank.
So could we potentially lower the salary down and boost that up, the difference with dividends, because we've already paid the company tax on it? Or is it same?
You could. Ultimately, you're going to get the same outcome. So the franking credits basically are tax credits that the company's paid to the ATO on company profits. And then when those dividends are paid out to the shareholders, depending on what the shareholders' marginal tax rate is, will dictate whether they have a top-up tax to pay. The company's probably paid 25%. If you're at the 49% tax bracket, you've got to pay that difference. So franking credits were originally brought in so that you weren't getting double taxed. Back in the day, you'd get taxed in the company, you'd pay a dividend, and you pay tax again. So it's eliminated that. You get the tax credit. You might be at let's say you pay a $20,000 dividend to yourself through a company and you've had no income that year. It'll have franking credits attached, but the first 20 grand that any individual earns in Australia is tax-free. That person will get a refund. So just depending on your marginal tax rate will dictate what the outcome is with the dividend. But I'm generally of the opinion to say you pay yourself a wage, you pay tax on the profits, and then when you, as directors and owners, go, we want to take some profits for ourselves now, then take the profits. You got to deal with the tax depending on your situation, because otherwise you want to be reinvesting those profits back into the business, right? So as you're on this growth stage, and I'm on the growth stage too, I've never taken a dividend. Like it's just I pay myself my wage every fortnight. But everything else gets reinvested back.
Yeah, you push it back in. We haven't done one yet, have we?
That'd be nice, wouldn't it?
Yeah,
especially when we see when we have big months in here and we see the pay going out. I'm like, fuck me, these guys are on good money.
Yeah.
We'd be better off as employees.
I think one common thing that we find a lot is, there's this whole thing around tax minimalisation. I want to minimise my tax. And of course we do. We all want to minimise our tax. But if you've got a $20,000 a month mortgage and you've got a $4 million house in Burleigh and you've got 2 kids and they go to private school and your wife doesn't work and this and that, and it costs you 30 grand a month to live, I can't pay you a 10 grand a month salary. Yeah, you'll pay less tax, but it just doesn't work. You're going to have a director loan and Division 7A and you've got to pay the money back and there's interest. And if you don't deal with it properly, ATO is going to double tax you on an unfranked dividend. It doesn't work. So as your lifestyle increases, I tell business owners this all the time, you got to get a little bit comfortable with, you're going to pay some more tax. If you want to live that life and have the nice car and have the nice house and the mortgage and go on the holidays and send the kids to the nice school, you can't do that off $100 grand a year salary. Regardless if you pay yourself dividends, someone's got to pay the tax on it and you will get hit with that top-up tax. Paying tax is a part of it in Australia. It's tough. No one likes doing it. You know, we do pay one of the highest tax rates in the world. But, you know, I think I said to you guys in our original meeting, because the question was, all right, how do we minimize this? It's like, you got to play the game that you're in, right? You can't really do a hell of a lot about it if that's what you want to live off. Minimization in the business and super contributions and prepaying expenses and let's reinvest here and do this and do that. Absolutely. The more you want to earn and spend and live off, you're going to get hit with that tax bill. So regardless if it's a dividend or a wage.
One of my favourite ones when we sit down with Mitch at his office and I'm like, mate, I've got a question, but tell me if it's just below the line. And everyone's sitting down, fucking, here we go.
Yeah, let's jump in.
No, it's good. I mean, I think the great thing about like our generation that are coming through is we've just got so much more access to knowledge and information on the internet, right? So you can Google these things and ask ChatGPT like, well, can I do this? And it's not always going to give you the right answer, but at least you can educate yourself a little bit more and be inquisitive around, well, what if I do this? And can I try this? And you might not be able to. And I'll go, you can't do it for these reasons. But in this scenario, if these things kind of lined up, you could do it. And you go, okay, I know something new here.
Yeah. So Harwell Dubai's not coming just yet.
Fancy a holiday.
Yeah.
Mate, there's a few myths we'd like to bust to finish off. We've kind of covered a few of them. But first one is, I don't need an accountant because I'm not making shitloads of money.
Look, if you are selling, you make some little trinket jewelry things every week in your house and you sell them at Carrara markets on the weekend for a couple of grand a year, you probably don't need an accountant. Like, keep a spreadsheet, income, cost me this to make, put it in your tax return at the end of the year, because you're going to pay someone to do that for you and you can probably do it yourself. I think once you get to the point of being registered for GST, that's kind of, to me, the trigger to go, I really need someone to be helping me with this, because you get your GST calculations wrong, you could be paying thousands of extra dollars to the ATO. And you got to be lodging things quarterly now. So you got to log on, you got to lodge it on time, otherwise ATO will penalise you. So I think that's the trigger for me to go, I really need an account if I'm registered for GST. Although some people go, I'm going to keep doing it myself. And again, you can learn a lot more these days than 20 years ago, right? It's not paper forms anymore. Zero, you can lodge BASs directly to the ATO. So it is easier for people to do. But the amount of times we get a new client because, I'm now at 150 grand and I think I need an accountant. And I go, mate, you've overpaid 10 grand to the ATO and GST, or you've underpaid 10 grand. Like, this is a bit of an audit risk. We need to fix this up. Like, shit. Okay, cool. Like, it does make your life a lot easier early on to just get someone that you can partner with. You might not need the full service at the start, but I think once you register for GST, that's kind of my go-to, like, go speak to someone.
But one thing we learned, and it maybe contradicts when people should bring in an accountant, I think it was calculating our buyback rate. Yeah. We've been reading Dan Martell, awesome book. And he has this concept of you need to calculate your buyback rate, and that's everything your company pays you across the year. So that's your salary, any cars, any business trips or holidays, whatever that might be, and then the net profit that you own. So for me and ads, it's the net profit at the end of the year halved. That is my income, and divide that by 2,000. That is my hourly rate, what I earn. Now, I can't remember what it was for us in particular, but what I'd pay you an hour to do the bookkeeping is an absolute fraction of that number. So yes, business owners might be able to do it themselves, but if they're spending 10 or 15 hours a week doing bookkeeping and their hourly rate, if they're client facing, is $150 or $200 an hour, they should have, the minute they can afford to pay you $400, $500 a month, whatever it is, they should be doing that, because it's then freeing up their time.
Absolutely.
The opportunity to bring more money back through the door.
Absolutely. And I think the great thing about the younger generation coming through is we kind of know this. That information is out there to go, all right, I'm making this much. It's going to cost me this much to do this. It makes sense to actually go and pay someone to help me with that. So yeah, I agree. You've got to be looking at what's it costing you in time versus what could I be doing, even if it's not making money. Like, even if it's 10 hours a week you're doing the books, and that could be time with your kids or your family or something like that. Like, there's also a cost to that. So you've got to be looking at all the things.
I love that. My last one is, I'll just sort the tax out at the end of financial year.
Majority of people do that, you know. We have implemented a service now moving into the new financial year where we won't work with clients now that don't want to pay us to do tax planning, because almost every lead and client we get, why are you looking to move accountants? Oh, I got hit with a surprise tax bill. or they didn't talk to me enough. Okay, cool. We're going to build in these services. These are non-negotiables. It's a little bit more expensive, but you know exactly how much tax you're going to pay and you know when it's going to be due. So you're never going to be hit with that surprise bill. And we give you ample time to actually do something about it. So you can leave it till after 30 June and deal with whatever the ramifications are of that then. You can't go back and change what's happened. So I would suggest not to do that. I would suggest if you're working with any accountant, I'd be asking for tax planning. If you're making more than $100,000 a year, or you don't have any money put aside for tax, and you're going, oh dear, I need to get on top of this. Even just knowing the number. All right, I'm gonna have to go find it. I've got to make it back up because I've spent it. But just knowing the number, it's just you can sleep a little bit easier at night knowing, okay, I've got to pay this in 9 months' time.
Mate, we've covered everything there.
Cool.
I hope that it's given people a good kind of pathway of at a very kind of basic level at times, just so they can learn everything they need to know from a finance perspective. Maybe there's a second episode somewhere where we look at more in-depth financial planning. Maybe Mitchy could be the resident podcast accountant.
The podcast accountant.
I'd love to. I think it's great. I think these conversations are good. Tax is one thing, but I think just financial literacy and mindset around money is where people really let themselves down. And it's of no fault of their own, I don't know how to build a house, so I need to go get someone to help me build that house. And it's just the same with accounting and numbers. And I think my message to people is like, don't be scared of it. Like, embrace it. Try and understand what you can, but also know that let me do what I'm really good at, and I'll trust these people to take care of that. And you're going to go a long way.
Mate, thanks so much. You speak so well, and you made it seem really easy, which I know it's not. So that's a skill in itself.
Maybe a whiteboard up.
Oh, mate, we'll be ready and raring. Look, if people PAYG earners and they want to do some of the stuff we spoke about with the super, they're starting the business, they're 2 years in and they're not getting the kind of service it seems like, what Wakefield Pacific do, where would they find you, mate?
Yeah, if you just Google Wakefield Pacific, we're on Instagram as well, Facebook, all the socials. Hit us up, send us a message. We've got a chat on our website where you can inquire as well, and we'll get back to you and show you what we can do for you, which is, again, we're more of that premium service. We're not going to just take on a end of financial year tax return. We just don't think we can provide enough value for that person. So we are really focused at business owners who are looking to scale, looking to grow. Our tagline's accountants for the ambitious. So we want to work with people that are going somewhere and want to try and push themselves to be the best that they can.
Awesome. And Mitch did say off air, if you use the code Two Blokes One Business, they give you 50% off for life. No, I'm joking. No, thanks for coming on, mate. We'll get all of that info off you as well, put it in the show notes so it's nice and easy for people to find you.
Appreciate it. Thanks, guys.